So, hi everyone. Today we have Mr. Anmol Das. So, just before we begin our next, this is the webinar that we do with all the fund managers and the research head. So, before we begin this webinar, let me just briefly introduce our speaker for today, who is Mr. Anmol Das. So, Anmol Das is the head of research at Swyom Advisors. So, he brings deep experience in equity research, portfolio construction, risk management, with a strong focus on identifying opportunities across the markets. So at Suyom, Anmol plays a key role in shaping the firm's investment framework, strategy design, and particularly active and absolute return-oriented strategy. So we look forward hearing from you today, Anmol. Welcome to our show. And topic of today's webinar is, why active strategies, especially CAT III alternative investment funds, can add value when markets go nowhere. So hi, Anmol. Welcome to our webinar.
Yeah. Hi, Gitansh. So, first of all, let me thank you for hosting me and welcome our viewers. And we hope that we share some good thoughts on alternative markets in the Indian market context. So,
Okay.
yeah.
Great, great, Anmol. So just how this webinar would be shape up. Let me just give you a little context. So firstly, we will be talking about how the markets are doing overall, the geopolitics and the global markets, Indian markets, and then we will talk about the category three AIFs, how they can benefit the investors, and then we will touch upon the offerings of Suyom, and then we will be just adding some closing remarks. So my first question to you would be like we have seen markets moving sideways for long stretches in the past also, and today also we see that markets are moving sideways. So returns may feel frustrating to investors as investors have not made money in last 1.5 year, especially those investors who have entered. So from a research perspective, because you are a research head yourself, so why are sideways market actually the most misunderstood play phase for the investors?
Yeah. So, Gitansh, I will give my view that see, seasoned investors they have good experience of investment of several decades in the market, and generally it is seen that whenever the market goes through a very bullish phase like we saw in the last 3 to 4 years, especially post COVID and post-COVID when the market returns were very high. So after that, what happens is that the market goes for a consolidation phase, and that consolidation phase it could be somewhere around 1 to 2 years, or sometimes it gets elongated a little more because the more higher the returns you have seen in the bullish market phase, the longer would be the elongation of the consolidation phase. And this consolidation phase generally is because the returns were expected on a low base effect in the previous years. But now, in the last couple of years, we have seen that the returns and the kind of growth that we have been seeing in the corporate earnings, that is not there anymore because of the low base effect not working anymore. So considering that, this current market phase is also one of that consolidation. And in the Indian context, I will say that India being a growth market, we are the fastest growing, largest market. And because of that, anyone considering or comparing India with advanced economies of Western Europe or North Americans, so that is not a fair comparison. So when someone says that India's valuations are at 22x on a PE basis, and that is very high, I believe that is not very high. That is rich enough, but still, fair because we are the fastest growing economy, and that justifies our rich valuations.
All right. So today, as we see that our indexes are also at its all-time high. If you see Nifty or 50, but Nifty 50 or Sensex, but if you see that most of the mid and small caps are down by say 30, 35, maybe 40% in the last 1.5 year, and there has been pain in micro caps. So what do you suggest to investors, in terms of stock selection or in terms of time horizon or risk assessment? Like what is the way forward? Do you see that mid and small caps are expensive, or do you feel that, now it's a good time to enter into mid and small caps?
See, most of the mid and small caps, including the index, we are already seeing that almost 20-25% kind of a correction is there in the mid cap indices, as well as on an individual stock basis. If you see, many good companies in the mid cap space are available at 25 to 35 percentage kind of fall from their all-time high or 1 year high prices. So these stocks are not bad. Of course, this is a consolidation phase, post-COVID, post the Russia-Ukraine war, when there was supply chain issues, and that was reflected in the revenue growth in several of the key sectors like chemical sectors and manufacturing sector. We also saw in the energy segment, natural gas prices, coal prices. So all of these, increased a lot. And then there was a fall post, all the supply chains adapting to the new norms. And that has created a kind of a phase where the growth is, kind of normalizing at its stable rate. So these mid caps are actually available at a good price, and they are successful, good business models. So obviously, we believe that this is a good time to enter into such mid cap stocks.
All right. And generally, what I have seen a lot of fund managers say that, going forward, it would be a stock specific selection and stock specific rally, then indexes moving at a very good pace from here onwards. So historically, what has been the market signals which, that we want to learn, which says that there can be a stock specific rally rather than index driven rally. So what are the signals that indicate this thing?
See, I will say that there are several such indicators, but the major ones are that a few things like whenever you see a sector, you see some of the individual stocks falling a lot compared to the sector leaders, and that is because the sector leaders generally they have a high reputation in terms of valuations they command, because of the kind of margin they have been able to maintain, no matter whether it was COVID or it was any war situation. So these kind of market leaders in their particular sectors, they kind of command a kind of valuation and respect in the market, and such companies are where the people park their money. While there are other companies which are peers to this kind of market leaders, but in valuation terms, they face a kind of a little more aggressive when the market is bullish, and again they get beaten down a lot when the market goes sideways, and because they are not able to post the kind of revenue growth or the margin improvement that they were earlier used to. So when you see these kind of companies, and you see a consolidation phase like the current one we are seeing, then I believe this is a good time to pick such kind of businesses which are available at a good price, and which have shown that the management is able to generate good growth and margin improvement. So such companies are the ones which we recommend in these times.
All right. And what do you feel that from here onwards, passive investment will do well, or do you think that, you being an active fund manager or active, primarily, heading the research, do you feel that active fund management will play a major role from here on?
See, I believe I would say that active fund managers, I mean, they are only relevant because in such sideways kind of markets, even the passive investors and the passive fund managers, they also have to become active to a certain level at least, because every fund manager has a duty to post good returns, generate returns and yields out of their portfolio. And in this kind of a sideways market, you cannot expect to post returns uh, beyond a point, because if you are a long only fund, then you are not going to able to generate returns. So many passive or even the not very active kind of fund managers, they also tend to take positions and change their positions and exposure depending upon the kind of market fluctuations. So that is there. And of course, in sideways kind of market, of course, the active fund managers role becomes more relevant because they have to be on their toes. Plus, there is always this thing that whenever some kind of a positive news comes, that positive news is taken with both with both hands by the market, and then the stock gets rewarded very quickly. But then the entire because there is no sectoral uh, tailwind to drive any particular stock for a much longer time. So the when the news starts to fade away from the market's memory in the next 1 week or 1 month kind of a time frame, depending upon the kind of event that had gone by. So and beyond that point, the market starts to forget that stock, and then again you see that the active fund manager have to book their closer, their exits from such stocks, and then again look for newer opportunities. So basically, I will say that an active fund manager's job becomes more of a manager who has to find new ventures where to park their capital, their investment for the time being.
All right. All right. And from your experience, you have worked with various companies before, joining Suyom. What kind of opportunities do you see in this kind of market? Like what kind of sectors can do well, or what kind of companies can do well from here, if you can throw some light?
Sure. So currently at Swyom, we are screening different sectors, and the one where we are most positive is currently the financial sector, the lending business, especially the NBFCs. NBFCs have already given good returns, but I will say that they have much more room to grow from here also. Second thing is on their profitability side, they are getting very good. Interest rate cuts have given them cost of funds coming down kind of a benefit. So that will allow them to maximize their profits. And they are also growing faster than the banks. And apart from the MFI sector, where there have been some asset quality concerns over the last 1.5 2 years now. Most of the segments or the retail consumers which consume the NBFC's credit, they are very much kind of able to repay. Asset quality concerns are at their very least concern levels. So we are very positive on NBFCs currently. And apart from NBFCs, we are seeing good opportunities in two, three other segments like the EMS segment, where we are expecting India's several companies to grow by taking a contract from Chinese or Korean or Taiwanese contractors to develop and assembly line setups in India, like the ones we have seen being set up in Noida for Oppo and other phone manufacturers. And then you have a Lenovo and other companies setting up, and they are increasing their production size also. Now they're shifting their production size from China to India because of the low labor cost that we have in India. So the EMS segment we are positive on, and we believe in the next 1 to 2 years, this segment, kind of will balloon in terms of overall exports from Indian market. The third one is, of course, domestic defense companies. I will not say the listed ones will be the most beneficiary, because apart from the Navy and the Navy ship manufacturers and a few companies in the defense side, government space, which are the big ones, there are several new defense startups which are coming up across from Central India, and they are into, like developing drones or maybe fuel systems for solid propellants for rockets and drones, kind of a thing for the missiles. So these kind of new companies which are coming up, from the chemical side or from the aerodynamical side. So these new age companies are small and they have a huge potential to grow. And because India's defense exports have just started to, flourish, we see almost, kind of next 5 to 10 years of huge growth in the defense exports. And we believe somewhere around 20 plus percentage of annual growth would be seen in this segment. So these are the two, three sectors we are very positive on. And then we expect the railways and the infrastructure segment to, kind of show some kind of resurgence. In the last couple of years, the government has not been allocating much towards the infrastructure and logistics segment, but we believe that may change in the coming budget as well as in the years to come, because India definitely requires a lot of investments in the bullet train kind of logistics things, or development of infrastructure highways for faster traveling, because uh, if you consider intra-city traveling within India, it has become a little difficult because for businesses to carry on and for freight to being transported, you need a faster communication routes, and that is where India is lagging in terms of its compared to its emerging market peers. So the government will need to do some investments in that part. So that is where we are waiting.
All right. And how do you see shipbuilding sector in India and the airline sector after, the Indigo, that crisis that happened? So any view on these two sectors?
So on the Indigo side, I will say first is that not particularly for Indigo, for the entire aviation segment, we are very positive. And see, as the standard of living of people as well as the income levels of people starts to increase, the traveling will increase across India. It will increase both in terms of domestic as well as international traveling. And we are seeing it in numbers already. But the thing is that currently India has to, buy their all their planes, aircrafts from outside. And globally also, there are only two companies which supply this mainly, the Airbus as well as the Boeing. And there is some kind of constraint that is happening because India's orders are getting delayed, and that has caused kind of you can say uh, little difficult for the aviation sector to properly flourish. If the Indian aviation companies had more planes, and they would have been able to provide even cheaper cost of travel, but that is not the case. Currently, we are seeing in the very recent example of that Indigo where the operations crashed. So we can see that the infrastructure was not enough to handle the kind of freight, the kind of passenger traffic that we were witnessing in the festive season. So somewhere deep down, the government needs to find a way either to rope in Boeing or Airbus to come and set up a factory in India and start building up planes in India, so that it will do both two things. First is Make in India will be made, under that Make in India campaign, it will be beneficial for us in terms of job creation. And the second will be that we will be able to, get faster plane deliveries, aircraft deliveries will be faster and more kind of a fair and transparent to Indian aviation companies. Now, coming to shipbuilding, I will say that is where India lags very much far behind, because most of the shipbuilding companies in India are the government ones, and they mainly make for a navy. And the ones which are private, they are not able to make ships or even the smaller boats for fishing, trawler boats or tugboats. Those kind of boats also they are not able to make of that very international quality. They are able to make the wooden kind of boats for the smaller you know uh, in domestic waters kind of freshwater kind of boats. So in that side, the government either needs to somehow make up a new company which will take up shipbuilding orders and help Indian shipping companies start more into trading and merchandise trading. So that is somewhere we are still lagging behind.
All right, got it. So now coming on to the second phase of the webinar where we will be talking about, why AIFs. So if you can start with taking a simple question for our investors who are new to this space of PMS and AIF, if you can explain how, your, or you can say any CAT 3 AIF is different from PMS or mutual funds.
So sure. So see, in a PMS, pardon me. So yeah. So any should I you
Yeah.
can change.
You can continue, yes.
So, talking about PMS or mutual fund, see, the mutual fund and PMS industry is constrained because of its high regulations on that industry and the players in that. So, for example, a PMS or a mutual fund, they cannot take positions in derivative segment and they cannot do so that makes them not able to hedge their positions or their exposures in the equity cash market, so that kind of constrains them to completely use the market flexibility options that AIF Cat 3 fund has. And similarly, the AIF Cat 3 fund has a flexibility of investing in pre-IPO as well as unlisted companies, so that is also not there with the PMS or a mutual fund company. Some of the mutual fund companies do take pre-IPO, not completely, I will say pre-IPO, but mostly an IPO kind of a subscription on an institutional investor basis. So that is there, but still a lot of constraints, put the PMS and the mutual fund players in a place where they are not able to reap the benefits of market movements, and that is where the AIF Cat 3 funds we are able to flexibly and being very agile, we are able to move and park our investment or change our investments from one place to other in a very quick period of time. So that is the one benefit that we have.
All right. So now you also follow long short strategy, means you also do some short strategies in your AIF. So how these tactical allocation, long short strategy, event based ideas become more effective when the markets, stop trending and markets start moving sideways.
So, see, in the long short strategies, I will say that what happens is that many a times we are not having, kind of a one direction or one mind that this kind of an event has happened and how that event is going to impact. Sometimes there is an impact on the revenue and there is an opposite impact in the margins. And then there are times when you have seen that some companies have rallied a lot, but now you are in a position when you want to, take a kind of a hedge position in order to, uh, hedge your position, existing positions. So that helps in long short strategy. It helps because we are able to hedge our position in the derivative market against some of our cash position or sometimes through our future position for the cash stocks. And that is not there in the PMS and mutual fund. So we get that advantage in our fund. Yeah.
All right, got it. So at Swyom, you are a research-focused, fund house, which is a clear objective to generate alpha. We have seen that as well. So, what do you exactly do in your research? Like, do you have certain checklists that you will only invest in companies with the ROCE of 15% and above, ROE of 15% and above? Do you have any checklist? What kind of research you actually do in terms of
So
when you start analyzing a company?
sure. So I mean, of course, we have this thing that we don't invest in any loss-making companies.
Okay.
So that is one thing, screener that we always keep, and then there are always certain red flags that we observe we when we interact with the management or when we are studying any company. So if some management is new to the market and they are sometimes a little more aggressive or a little more ambitious, and they tend to give a sky high kind of a guidance in these kind of markets. Now, I will not be able to take the names, but there have been a few companies, especially in the from the IPO market, which we have met in the last 6 to 8 months kind of a time frame, who have come out with their IPO, and they have when they came out with their IPO, they were able to give very sky high kind of guidance that they have got huge contracts, they are doing a lot of capex, and all of that kind of changed as the export markets not got impacted because of the Trump tariffs, and several order cancellations happened for India in the pharma sector as well as in the manufacturing sector, in the capital goods sector. So these kind of things have happened, and this kind of red flags we observe that if the management is trying to give too much of a sky high kind of guidance, we try to be more realistic. What we believe would be the thing that we would go rather than management guidance. Third thing is that we always see whether a company is how much it is leveraged. If it is very highly leveraged, then we try to avoid such companies because uh, when the times are tough, the margins get very thin, and we have seen in the past that if any company starts operating in thin margins, then they kind of try to continue their growth momentum. So they try to do capex using a lot of more debt. So if you already have high debt and you are taking more debt during a sideways kind of a market or during a time of a low margin growth kind of a business environment, then at these times those companies going ahead, they struggle a lot in order to kind of take away the debt out of their balance sheet or prepay that debt. So we try to avoid such companies. And the last thing is that we see the promoter shareholding. So whenever we see that there is a promoter who is uh, every promoter has a right to sell their stakes in their company at the highest price possible for their own personal gain. But you have to understand that being a promoter of the company, if you are trying to offload your company's shares or your stakes, even by some extent only, but at a price at which is very high on a valuation terms, and it looks as if the promoter is just trying to cash on. So we try to avoid such companies or such kind of valuation levels of such companies, even if the business is good. Because what happens is that once the promoter is shelling out or once the promoter is exiting, so that gives the impression that might be the business is not going to remain this highly profitable in terms of margin wise or return wise as it was, or growth wise also. So these kind of concerns are there, and we follow these kind of red flags very dearly to consider in our stock screening process.
Got it. And how important is risk management for Suyum? And how do you think? How do you see that you minimize the risk for the investors that are entering in your AIF?
So, whenever we are buying any stock, we always see that what kind of growth, what kind of margins, and what kind of returns the company is generating, looking at their financials. And going beyond their financials, then we see their business and the scope of their business, the uh, total addressable market currently, and the serviceable operational market that they will be able to target. So we study these things, and then we try to find out if the kind of growth that they were able to generate, and the kind of valuation that they were able to command because of that high growth. whether they will be able to maintain that growth. Because if you are not able to maintain a growth of, like for example, if you are growing at 35% revenue growth, then you can command 100 kind of a PE in the valuation terms in the market. But if your growth comes down from 30-35% down to 20% or 15%, then suddenly you will see that that company's valuations, they either crash, or they remain sideways for a long period of time, for the business to scale up to that size, because the valuations are not matching the growth anymore, or the growth is not matching up to the valuation, you can say. So we try to avoid these kind of companies where the growth or the margins are getting compromised, and yet the valuation demanded by the company in the market is very high. So rather going for hero zero kind of stocks, we try to pick up companies which have a solid business model, which have a sustainable business model, and their growth, even if comes down, it's not going to go negative, or it's not going to get stalled. So rather, if it should keep growing at a particular kind of a minimum threshold level, and then forward, its profitability can also get maximized in good times. So the downside risk has to be protected, and the hero zero stocks have to be ignored, or avoided.
Got it. So now coming on to the current allocation of Suyom, like how many stocks do, if a 1 crore is given to you, how many stocks it is allocated to, and what kind of cash levels you are maintaining, and what kind of market cap is a company in which you are comfortable investing in?
So we at Swyom are a flexi cap fund. So we have exposure in the unlisted space as well as in the cash market side. We have exposure of almost 60% plus, and we have unlisted shares somewhere around 20%, below 20% currently actually, because one of the companies got listed, and then we have our hedged positions in the derivative segment, where we trade with the large caps as well as our hedged positions of the cash companies. So overall, we maintain a kind of a, in AIF Cat 3, you have the SEBI, advantage that you can take up to 200% kind of exposure. So we generally try to maintain 120, 130% is kind of exposure, not going very far off high, or not going very low in terms of our returns and risk profile. We are aggressively looking for growth companies, so we maintain that kind of exposure levels. And generally, in our cash portfolio, we try to maintain the mid-cap companies from 5,000 to 40, 50,000 crore kind of a market cap companies. And the companies whose market caps are more than 50, 60,000, they are available to us in the derivative market as well. So we try to keep our hedged positions in such large cap companies in the derivative side, with exposure somewhere around 30, 35, 40% kind of, depending upon the kind of market that we are seeing.
Okay, and what about the unlisted segment? How much is into unlisted segment?
Unlisted segment, generally, we try to keep it somewhere between 20-25%. Recently, one of our unlisted investments got listed, Vikram Solar. It was the first investment that Swyom India Alpha Fund had made in unlisted space, and we got good returns out of this company. So post that, no other listings has happened, and we are yet to increase our unlisted space investments. We keep on evaluating companies, but because as you are seeing that a lot of new fundraisings and new pre-IPO deals are coming, so a lot of them are getting valued at very high valuations. So currently we have not done any fresh investment in the unlisted space for last 2-3 months. But we keep on looking into new companies, and whenever we get the right opportunity fitting in our consumption theme, then we obviously take that opportunity.
All right. And what about the small caps in the portfolio? How much allocation you give to small caps and what kind of market cap you are going looking for in a small cap company?
We don't maintain as such kind of a bar that how much of a small cap or mid cap allocation we will keep, depending upon the kind of deal or kind of company that we are getting. Sometimes we do get some, IPO or anchor position in any IPO, and the company is good, then we do take positions. And generally, in the small cap side, we maintain around somewhere around 10% kind of exposure. And the mid caps are our main focus, where the companies are sustainable, they have proven business model and are listed for some time. So we try to generate alpha from that segment, mostly in our cash portfolio.
All right, got it. And you were telling me one thing that, AIFs have an advantage. They can go up to 20, 200%. You were saying some line. So if you can elaborate this, benefit that has been given to AIFs for our audience.
So, see, when we are taking any hedged positions in the derivative segment, then our positions are hedged against our cash or future kind of contracts. So that allows us to increase our, you can say, exposure by some times, depending upon the kind of MTM margin that you get against any cash or future stock. So because of that, in the derivative side, you get good margins, and you get higher exposure compared to the cash you have to keep in that. And coming to the 200% kind of thing, so SEBI allows 200% kind of maximum exposure that you can have in an AIF Cat 3 fund, but we generally try to keep it somewhere between 120 to 100 35 percentage. We don't go beyond 140. We haven't gone, in fact, beyond 140, because that is where we believe the markets could go risky, because obviously the markets are at all-time high, and we also have our risk management framework to look upon, and we try to maintain somewhere around 120 percentage kind of exposure.
All right. So, and how do you decide when to exit a position that you have taken? Like, what are the things that make you exit a stock?
So it depends upon the company to company. If the investment thesis was a long-term thesis, with a good kind of a price target, and then we have to analyze that company's recent quarterly earnings, and then accordingly we take our call that this is the best quarterly earnings that the company can deliver. And post this quarter, the company might not be, able to see the kind of growth it has seen, or the kind of margins that they have been able to make up. So considering that, sometimes we take our call that now we are exiting this position in a particular company. And depending upon investment thesis, sometimes there are investment thesis regarding any particular impact of a sectoral or any kind of a business event. Like, for example, if some company is producing material A, and that material A requires raw material B, and the prices of raw material B is kind of increasing over the last 1 to 2 quarters. We are seeing in the commodity markets or global markets. Then we take a call that because of the increasing price of the raw material, the prices will be passed on to the consumers. And because the rise in raw material cost, there must be good demand, so there will be premium as well when the prices are rising. So in such times, we take a call that seeing the external demand of external things, or raw material prices, or any kind of other business movement or sectoral event happening, then we take a call that what kind of companies we should exit, and at what levels.
All
Yeah.
right, got it. And now coming on to the commodity side, like gold, silver. And so how do you see, because gold and silver has been favorite for all the investors, especially for the Indian ladies, if I talk about, so it has already run up. So how do you see that gold and silver, and are they part of your portfolio?
Um, I will not be disclosing anything regarding the portfolio side, but I will say that see, currently geopolitical events are the ones which are driving the prices of these commodities, the precious metals, both gold and silver. And silver, in fact, has two drivers. First is that it is being a precious metal, and the second is it also has industrial use, and it is seeing huge demand from China. And China is already, I think, the second largest producer of silver also. And it is being used a lot in the electrical wiring in the EV industry. So because of that, silver is seeing a higher rally in comparison to gold. And coming on the geopolitical thing, we believe that there is a global power shift that is happening. And this power shift will be continuing for some time now. So we believe that till the time this global power center shifts from North America and Europe back to Asia, between rising China and India, and Russia also resurging. With that, we believe that the central banks, which have been buying gold for the last 1 to 2 years, especially over the last 6 to 8 months since the Trump tariffs have been coming up, we believe the uncertainties have been driving these gold and silver prices. And this thing will continue in the future as well, because central banks are not, considering any more acquiring US dollar denominated treasury bonds anymore, because the confidence on the US hegemony and the dominance has kind of shaken, and geopolitical events are driving this. And probably the central banks will keep buying more of gold, and we might see in the next 5 years the gold prices, kind of get multiple times also from here. There's a high probability of that happening.
All right, got it. And how do you see the latest geopolitical situation, that has happened, where on Venezuela there has been attack by US? You do you have any views on that?
No, I mean, that as a political thing, I don't have any views on that. But I can say that the direct impact on India will not be there, because India hardly has much of any, oil imports done from Venezuela lately, since 2020, I believe. But overall, and Venezuela was not, able to, even if they were having the largest oil reserves, they were not producing oil or exporting oil that much. So don't believe that crude oil markets will be flooded because of US companies going or entering Venezuela. This is more of a geopolitical thing that is happening there, and we believe that crude oil prices will remain these kind of levels, or may get even softer. 10-20% plus minus thing could happen, but overall there's this power shift that is happening, and that is something which no one can stop. uh, doesn't matter whether the US wants it or not. So that thing will continue, and that will keep driving the prices of gold, that is for sure. So that
Right.
will be.
All right. I think we have covered all the things. So I will just, if you have anything to add on, otherwise I will just give the closing remarks. You have, elaborated it quite well.
Thank you.
Yeah. Yeah. So thank you, Anmol, for being the part of, such a clear insight that you have given to our audience. And, sideways markets are something which do not make headlines, and investors often get frustrated, bored, because they don't see returns in, 1 year or 1.5, 2 years. So that is the main, time where the processes, research driven fund managers, or say research heads like you, and, active decision makers truly matter. So thank you everyone who joined us, and we really appreciate Anmol for joining us today. Thank you.
Thank you. Thank you.
Thank you.